Today is May 25th, 2025. The United States government needs to borrow a lot of money. This is because it spends more than it collects in taxes. This difference is called the budget deficit. To cover this deficit, the government sells U.S. Treasuries, which are essentially IOUs. Recently, these deficits have been very large. This means the government has to issue an enormous amount of new treasuries. This increasing supply of debt is a fundamental reason why some buyers are hesitating. It's a lot for the market to absorb, and this basic fact is starting to weigh on investors' minds. The sheer volume is becoming a significant concern. At the same time, interest rates have risen. The Federal Reserve, America's central bank, increased rates to combat inflation. When new bonds are issued offering these higher interest rates, older bonds with lower rates become less attractive. Think about it. Why would you want to hold a long-term treasury paying a low interest rate when you can get a better return from newer bonds or even some savings accounts? This makes those older, long-term treasuries a harder sell. Investors are looking for the best return on their money, and right now, many existing treasuries don't offer that competitive edge. This shift in the interest rate landscape is crucial. The combination of more bonds for sale and better returns available elsewhere creates a difficult situation. The market must absorb this huge supply of new treasuries. If there aren't enough buyers willing to purchase them at current prices, the prices of these bonds can fall. When bond prices fall, their yields, which is the return an investor gets, go up. This is necessary to attract buyers who are now demanding more compensation for holding U.S. debt. This dynamic is a classic example of supply and demand at work, and it's putting pressure on the treasury market, a cornerstone of the global financial system. This environment presents a real challenge for the U.S. Treasury Department. Its job is to manage the government's financing needs, which means selling these bonds. But if buyers are hesitant, this task becomes much more difficult and potentially more expensive. If the government has to offer higher interest rates on its new debt to attract investors, its borrowing costs increase. This in turn can add to the national deficit, creating a somewhat vicious cycle. Investors are watching these developments very closely, aware that the stability of this market has broad implications for the entire economy. A significant factor in the treasury market is the behavior of foreign buyers. For many years, countries like China and Japan were major purchasers of U.S. debt. They held vast amounts of treasuries as part of their foreign exchange reserves. However, this trend is changing. These large international buyers are now purchasing fewer treasuries, and in some cases they are even reducing their existing holdings. There are several reasons behind this shift. Geopolitical tensions, particularly between the United States and China, play a part. Countries are also increasingly looking to diversify their investments and not be overly reliant on one single currency or asset. This desire for diversification is a key motivator. Central banks around the world are reassessing their reserve management strategies. Holding a large concentration of assets in U.S. dollars and treasuries carries risks, especially in a changing global landscape. Some nations are using their dollar reserves to support their own currencies, particularly if their currencies are under pressure. Others are seeking potentially higher returns by investing in different assets or regions. For example, Japan has recently faced challenges with its currency, the yen, prompting actions that might affect its treasury holdings. This pullback from traditional large buyers is a noticeable and important development. Beyond foreign demand, there are growing concerns about the fiscal sustainability of the United States. The U.S. national debt is already very large, and it continues to grow at a rapid pace. A critical measure economists watch is the ratio of this debt to the country's gross domestic product, which represents the total value of goods and services produced. This debt-to-GDP ratio has been climbing, leading some investors to question whether the U.S. can effectively manage its finances over the long term. Political disagreements within the U.S. regarding government spending levels and taxation policies only add to this sense of unease and uncertainty. If investor confidence in U.S. fiscal management erodes significantly, they might demand much higher interest rates to compensate for what they perceive as increased risk. This would make borrowing substantially more expensive for the U.S. government, further complicating its budget challenges. Maintaining fiscal responsibility is widely seen as essential for ensuring the continued attractiveness of a nation's government bonds. The current trajectory of U.S. debt is raising red flags for many economists and market observers. These are not just abstract numbers, they have tangible consequences for the cost of borrowing and overall economic health. The weakening demand for U.S. Treasuries has direct implications for the U.S. dollar. Since Treasuries are predominantly bought and sold using U.S. dollars, a decline in the appetite for these bonds often translates into reduced demand for the currency itself. If fewer international investors are buying Treasuries, they need fewer dollars to make those purchases. This dynamic can exert downward pressure on the dollar's value relative to other major global currencies. A weaker dollar, while potentially beneficial for U.S. exporters, can also make imported goods more expensive for American consumers and businesses, potentially contributing to inflationary pressures. The Federal Reserve, the U.S. central bank, finds itself in a delicate position. If demand for Treasuries from foreign and private domestic investors falters substantially, the Fed might face pressure to intervene. One way it could do this is by purchasing Treasuries itself, a policy known as quantitative easing or QE. While QE can help to stabilize the bond market by creating artificial demand, it also involves injecting more dollars into the financial system. This expansion of the money supply could potentially lead to a further devaluation of the dollar and ignite concerns about future inflation. Alternatively, the Fed might opt to keep interest rates higher for a longer period to try and attract buyers, but this too has economic consequences, potentially slowing down economic growth. Amid these concerns about traditional government-backed assets, gold has seen its appeal increase. Gold has a long and storied history as a safe haven asset, a reliable store of value, especially during times of economic uncertainty or instability. When investors become worried about the long-term viability of government bonds or the stability of major currencies like the dollar, they often turn to gold. It is a tangible asset, not directly tied to the fiscal or monetary policies of any single country. Therefore, worries about rising U.S. debt levels and potential dollar weakness tend to make gold shine more brightly in the eyes of many investors seeking to preserve their capital. Alongside gold, cryptocurrencies, particularly Bitcoin, are also drawing attention as potential alternatives. Bitcoin is a much newer asset class compared to gold, but it shares some characteristics that proponents find attractive in the current environment. Often referred to as digital gold, Bitcoin operates on a decentralized network outside the control of traditional financial institutions and governments. Its supply is algorithmically limited, which advocates argue makes it resistant to the kind of inflation that can result from central banks creating excessive amounts of money. As concerns about the safety and yield of U.S. Treasuries mount, some investors are exploring Bitcoin as another avenue for diversification and as a potential hedge against systemic risks. The current challenges facing U.S. Treasuries could signal broader long-term effects on the entire fiat currency system. Fiat currencies such as the U.S. dollar derive their value from government decree and public trust, rather than being backed by a physical commodity like gold. U.S. Treasuries have long been considered the world's primary reserve asset, the ultimate safe investment. If this cornerstone asset faces sustained questions about its reliability and value, it could subtly undermine confidence in the wider fiat system. This doesn't imply an imminent collapse, but it does suggest that a period of significant reevaluation and adjustment within global finance might be upon us. In such an evolving landscape, assets like gold and Bitcoin may find themselves in a favorable position. These assets operate largely outside the direct control of any single government or central bank. Their appeal often grows when traditional financial anchors like government bonds appear less secure or offer diminishing returns. Investors who are seeking to protect their wealth from potential currency devaluation, high inflation, or the risks associated with growing government debt might increasingly allocate a portion of their portfolios to these alternatives. This trend could gain further momentum if the underlying fiscal and monetary challenges in major economies persist or worsen. The diminishing luster of U.S. Treasuries also has profound implications for the architecture of the global financial system. For many decades, these bonds have served as the bedrock of international finance. They are widely used as collateral in financial transactions, act as a benchmark for pricing a vast array of other assets, and form a substantial part of the reserve holdings of central banks around the world. If the status of Treasuries as the ultimate safe asset erodes, it could lead to increased instability and volatility in global markets. It would also necessitate a search for new benchmarks and alternative reserve assets, a transition that would likely be complex and potentially disruptive. Ultimately, what we are witnessing is a significant challenge to the established financial order that has prevailed for much of the post-World War II era. The confluence of soaring U.S. government debt, a global environment of higher interest rates, and shifting geopolitical dynamics is compelling a fundamental rethink of risk and safety. Both individual investors and institutional policymakers must navigate this new and uncertain terrain. The long-term consequences will largely depend on how these multifaceted challenges are addressed by governments and central banks. However, it is becoming increasingly clear that the financial world is in a state of flux, and the very definition of a safe asset may be undergoing a lasting transformation.